Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, Skipper's the next stock on our radar. Reported a strong showing in the first quarter, registered record quarterly EBITDA, while order book as well was at record highs. We have Sharan Bansal, Director of Skipper, who joins us on the show. Hi, Sharan. Good to see you win. Well, good set of numbers. It seems the street liked it, and it appears you'll have an industry tailwind as well. And, the numbers seem to be picking up from here on. But for the first quarter, the growth that you've delivered is close to around 15% approximately. For the year, you were guiding for a 25% growth. Do you think you have enough in store to achieve that 25% and make up in the coming quarters?
Hi, Nigel. Yes, absolutely. We are fairly confident that 25% growth is very much doable in this financial year as well. We have grown very significantly. We've had more than 100% growth in the last 2 years, starting from a 2,000 crore top line in just 2 years ago in FY23 to ending with a 4,600 crore top line in FY25. Even from this elevated base, we are fairly confident of delivering another 25% growth. And that's going to come about on the back of our capacity expansion, which we commissioned recently. That got commissioned in Q1 of this year. So we did not get the full benefit of the new capacity in Q1, but from Q2 and 3, we expect to get the full benefit. So looking at the order book, which is 8,000 crores plus now, 25% seems definitely on the cards.
All right, 25% seems on the cards on account of the orders that you already have and the increase in capacity. But there are a couple of, headwinds as well. One of them is the shortage of manpower. The second is that you have increased your exposure to the US, where uncertainty around tariffs are underway as well. So in light of all of this, what does the order pipeline look like? We've looked at around 30,000 crore worth bidding pipeline that you've spoken about. Given the historic 20-25% sort of run rate, do you think that an additional 7,500 to 8,000 crore of order wins can be possible this year?
Okay. In terms of manpower, yes, you're absolutely right. That remains the biggest challenge in terms of ramping up execution. We are taking a number of steps in terms of recruitment, upskilling and training of manpower. And hopefully that's something which we will be able to deal with in line with the enhanced execution. The US currently makes up just about 1% of our order book. So it's not really significant for us as of now. And the situation on the tariffs is a very, very fast evolving and a dynamic situation. This is really something which we will have to wait and watch to see which direction it goes. However, we have enough opportunities in a number of global markets. Middle East is something which is very significant for us. Recently, in this quarter, we secured a very significant engineering order. It's not a supply order, it's a pure engineering order for Middle East's largest utility. So that is quite significant for us as well. And, we have sufficient amount of opportunities in other markets like LATAM and Australia as we speak. So the pipeline, of course, like you mentioned, is healthy at 30,000 crores. And even if I consider a conservative 25% hit rate that we have been delivering over the last several years, our order intake guidance of about 6,500 to 7,000 crores this year should be very much possible.
Okay, got it. And exports as a percentage of mix, where does it stabilize at?
Exports as a percentage of our order book as of now is just about 10% overall. In terms of our execution this year, we expect this to be somewhere around 15%. We have been taking in export orders roughly to the tune of about $100 million every year. Roughly 700 to 800 crores is what our export order intake and execution has been. This year, looking at our enhanced capacity coming online, where we will be able to take on more short-term export orders as well, and looking at our increased penetration into a lot of key markets like the Middle East, which I mentioned earlier, we believe that we can easily aspire to double our annual export order inflow from $100 million to about $200 million annually. So this is what our target will be to intake in this year.
Wow. So you are looking to double your export execution. Could you give us a sense on what does that do to your margins overall? Because there are two drivers as we see it. One is increased exports coming in. What's the delta between domestic and export margins? And secondly, some of these high-value T&D contracts with increasing complexities that you are delivering, what do they account for in your overall sales mix right now and your order book? Where do they go from here on?
Okay, so I just want to correct that in terms of export execution, it will be in line with, as I mentioned earlier, about 15% this year, because on the back of our order book that was there last year, our guidance for higher exports will be the order inflow for this
Got
year,
it.
which will result into execution of next year, perhaps. In terms of margins, definitely exports have a better effect on margins, and they come with about almost 1.5 to 2% better margins. Company has been consistently improving on margins also. If you look at Q1, we've delivered about 10.1% EBITDA compared to 9.6% overall last year. So we believe that overall 50 basis point EBITDA for the full year is very much possible for us as well. And in terms of the high value T&D margin projects, yes, we are executing a number of them. Most of our projects are in the highest voltage category, which is 400 and 765 kV and 800 kV HVDC. So yes, certainly as those executions come in to play, we can expect better and better margins ultimately to get to the long-term aspiration margin of 12% in the company in the medium term.
Okay, all right. What about working capital days? They had improved last year on a steady state. Where does it stabilize at?
Yes, you're right. We were able to improve working capital to just about 90 days last year. We believe that certain more optimization is possible. So we should be able to bring it by reduce it to another maybe 10 days or so in this year. We are at the best working capital days in the industry as of now. And in terms of what we are more happy about is the finance charges. We have been able to deliver a significant, improvement in finance charges as a percentage of revenue, which was about 4.6, 4.7% of revenue last year. This year, if you look at Q1, we've already delivered about 4.2. And I think for the full year, we should be closer to 4% or as a percentage of revenue.
Finance cost as a percentage of sales from 4.5, it's come down to 4.2. You'll end at around 4%. And the working capital days, sorry, I missed the number.
We're at from 90 to about 80 days we should be able to achieve.
And very quickly, the polymer part of the business, that's a smaller vertical that's growing quite fast. Any signs of slowdown for the year on an annual number? What can you tell us? What will you achieve?
Polymer, we are very happy that we have delivered a good set of numbers despite not much business coming in from Jal Jeevan Mission projects. Those are pretty much non-existent right now. But despite that, the increase in plumbing sector business has led to this increase of volumes and execution in this vertical. And we are confident that overall in the year, 30 to 40% growth in this vertical should be possible.
All right, 30 to 40% growth. And just a one-word answer on infra. It fell 39% this quarter. What's the outlook for this year?
Infra is just a function of, the project execution. So again, overall for the year, we are pretty confident that we should be able to get 20-25% growth in this vertical as well. Again, quarterly execution may vary from certain quarters depending on the contracts.
Take that point, reasonable there. Thank you so much for joining in, Sharan, and giving us an outlook for this year. Wish you good luck for the execution part and order inflow part for the entire year as well, with 50 basis points margin expansion.